Hey everyone, welcome to another video on my channel, and today in this video I am going to tell you how I am approaching trading since April or the new financial year. So you must all be aware that I was trading expiry days very actively and used to do very little positional trading. But now, as you all know, expiry is becoming harder and harder day by day. There are a lot of spikes which are coming up, which is taking out our stop losses. Not just that, so sometimes when these spikes comes, stop loss doesn't even get hit and we get a stop loss jump where we end up squaring off, because within seconds the option premiums will just end up doubling or tripling. So this is an issue which is being there persistently from the month of February and March. So every single day, I would say. So this was something which was occurring maybe once a week or twice a week, but at least from late March, so this issue is occurring almost every single day, and it is becoming much harder to trade expiry for a simple reason, because so on an average day, if you end up making something like 0.1, 0.2, 0.3%, so usually, as you all know, that we aim to make around 24% a year, that is 2% a month. So gradually and slowly we would have added up to 1.5%, 1.8%. One bad day is wiping out either half of the entire month's profit or even the full month's profit. So let's say there was a spike which recently came in Nifty, if you all remember. So that is not the previous but the other previous expiry. So what happened in Nifty was the 22,000 put option was trading around 3 rupees, and I had shorted 22,000 put option at 3 rupees and kept the stop loss at 7 rupees. So it is not that I had kept no difference between trigger and price. So I had actually kept a difference of almost around 1 rupee, so 7 and 8. So what happened at this point is the price actually came till around 6 or 6.5 and suddenly jumped to 8.5. So I was short quite a lot of quantity. So initially I had shorted the same put option at 8 or 9 rupees, and currently it was trading around 3 rupees. So what ended up happening is when this jump came, the entire stop loss got skipped, and within fraction of a second it ended up going to almost around 20 or 30. Before I could go back, cancel my stop loss order and again come back, the option had shot up all the way to 80 or 100. So then luckily I just waited for a couple of seconds. Once it came back, I ended up squaring it off at 60 rupees. The option which has sold at almost around 8-9 rupees, and I had trailed my stop loss to cost, right? So the stop loss jumped, and not just jumped, I ended up squaring off almost around 6 to 7 times higher than my stop loss. So this day I ended up losing almost around 2.5%, and my entire April month became negative. So if you see my overall April month, I think I'm down almost around 2%, because after that also a couple of days were not good. Somehow I was able to manage the Sensex down move, somehow I was able to manage even the mid cap down move, but unfortunately I got stuck with the Nifty down move. So I had kept stop losses, luckily for me, all with Sensex and mid cap the stop loss got triggered, but it completely missed with Nifty. So this made me rethink, and it also made me change my approach, because this is not going to work out. So whatever I make in say 1.5 2 months, if I'm just giving it up in one day, so in long term this is not a great trading method at all, right? So previously, if you go back 1 year or 2 years, these were the spikes which you never used to see, right? So hardly you would have instances where a stop loss would get jumped, especially when you're keeping 1 or 2 points difference between the trigger and the limit. And that too, I'm talking about an option trading hardly in single digits. So there might be a case the stop loss can jump if the option is trading in 3 digits, right? So here we are talking about 5 rupee, 6 rupee option jumping 1.5 2 rupees at once, right? So before we get into what exactly I'm doing, right, so we will also try to discuss about why exactly it might be happening. So I will tell you certain reasons of the same. So before we move on, make sure you hit the like button, share this video, and also subscribe to my channel. So because it is hardly a matter of few seconds for you to subscribe, and it is also absolutely free, but it would mean a lot to us for if you are making a video regularly. So you subscribing to the channel and liking the video would really motivate us, right? So now let's try to understand why these moves could be coming. So now when you take a look at option trading as a whole in 2017, there were only few players who participated, right? So especially if you take a look at option selling, there were hardly so less players that you could easily go sell options and didn't even have to bother throughout the day, and you would make your money. So during 2020, a lot of people started coming into trading, and especially option selling. So whoever entered the markets new started with option selling, because it was a known fact that option selling has higher probability, option selling is easier to make money than option buying. So there was a large influx of traders into selling options, and during this time even time-based short straddle started to become very popular. And this was another reason where people used to just come in, sell a straddle, put a stop loss, and they used to go ahead with their daily chores, right? So this period of 2021 gave excellent returns to option sellers, whoever did time-based short straddles. So they ended up making really good money. So but the thing is, all good things don't last forever. So if money can be so easily made by just selling options and putting a stop loss, every single person will simply end up doing that, and they need not even buy options, right? So there is nothing which can work so easily, so consistently through a long period of time, right? So now what this does is, if everybody starts doing a same thing, then it gives really good opportunity for bigger players to hunt them. Let's say you're selling an option at 50 rupees, there would be a huge chunk of stop loss orders, not just from you but various other people, where they would have placed a stop loss anywhere between 75 to 100 rupees, right? So now, as a, let's say, a huge institution or a big institution, I know for a fact that there's a large chunk of orders between 75 and 100. So if I can somehow end up taking the price up to 75, I can easily trigger all the stop losses, because it's more like a domino effect. The moment the 75 stop loss starts to trigger, it will automatically trigger the stop loss of 76, 77, so on, and all the way up till 100, right? So it's a very easy target. The moment I push it till 75, I can easily trigger even up till 100, right? So this is a very simple logic, and people with large money can easily end up doing that, because it is not just one person, there's a huge group of millions of people who are doing the same thing again and again from years, right? So this is where the larger players come into picture. So people were not really aware. So people knew that, okay, there will be large hedge funds which will be trading against, there will be large hedge funds which will actually be trying to act as hunter algos. But all this came into real light when there was a case in US. So the hedge fund called as Jane Street put a case against two of its old employees or ex-employees, and also against a firm called as Millennium Capital, right? So they put a case saying that they were using a proprietary trading strategy with which they had made close to $1 billion in profit the previous year. So $1 billion is almost close to around 8,000 crores or 8,300 crores previous years just from trading. And this proprietary strategy was actually leaked by the ex-employees to the Millennium Hedge Fund, and because of which their profit margin has come down by 50%, right? So previously, let's say in a month you would be average making around 800 crores, but that has now come down to just around 400 crores, because this strategy has now been leaked and there are orders which are being placed counter to that, right? So now all this was happening, but by mistake, right, the lawyer, so it was not intentional, by mistake the lawyer mentioned that this was happening in the Indian market. So till then it was not aware where exactly they were trading, what exactly they were trading, but this was made public as an accident, that where the lawyer said this whole thing was happening in the Indian market. So this, as you know, created a huge buzz. So everybody started talking about the Jane Street. So Jane Street, if you actually take a look at it, it not just is a hedge fund which only does option trading. So they manage close to around $300 billion. So in this $300 billion, around $15 billion, I think they use for trading. So this is what I read. So I'm not really sure of the figures, so I might be wrong, but I guess somewhere around $15 billion out of this is used for active trading. This Jane Street, which manages $300 billion, is quite big, but it is not the biggest. So there are funds which are much bigger than Jane Street. So Jane Street might only be deploying around $15-20 billion, but there are funds which deploy even $100 billion plus only into trading. So now you can just imagine this small firm itself, if it is making around 8,000 crores from Indian markets, so then you can also imagine about the larger firms, right? So now these people will have something called as co-location servers, or they would be using HFT, high frequency trading, right? So for us, what will end up happening, we get tick every once a second. So 1 second you get one tick, it's another second you get one tick. The best case the broker offers can be something like 2 or 3 ticks, and even let's say the best of the best case you might get 4 ticks in a second, but that is extremely rare. Why? Because for you to just blink and open an eye, it would take close to around 400 milliseconds, right? So even if they end up offering 4 ticks, your eyes cannot even perceive that, right? So the max you can do is maybe 2 or 3 ticks a second. So anything more than that, your eyes can't even perceive it, right? So given this, we will be only dealing with 1 tick, 2 tick, 3 tick per second, but HFTs will be dealing with hundreds of ticks per second, because there's no human sitting and trading. There is a machine which can interpret data much faster, right? So it can not just interpret but also execute much faster than any of the human. So this will give a huge opportunity for bigger players, because one, they have big capital. The second one, most importantly, right, so they have access to the latest and the top most advanced technology. So putting both together, right, so they can, with let's say a capital of 10,000, 20,000 crores, they can easily move the market the way they want. So they can build up their option position, try to push the market in the direction they want. So especially if you take something like mid-cap select, there are hardly 50 stocks in the mid-cap select, and all of them are smaller companies. So if you have anywhere around 20-30,000 crores, you can easily cause mid-cap to move by easily half or 1%, right? And if you have built a very strong positions with options, so this 1% move is more than sufficient for you to mint profit in crores, right? So this is what is currently happening, and with so many option sellers coming and trying to trade 0 DT every single day you come, there is one or the other expiry, put a stop loss, trade. This also makes it a very easy target for bigger people, right? So they can easily come and target our stop losses, make it hit and bring it back to the normal zone. So this is a regular occurrence in the market, and a lot of people are doing it. So I can't even say how much more money has been lost by all the retailers into these hedge funds, which are making or earning in billions of dollars, right? So if this itself has made 8,000 crores, there would be hedge funds which would have made anywhere around 20-30,000 crores. And since trading is a zero-sum game, all this would be money of you and me, right? So people who have lost money in the market, our money would have gone to them, right? So the thing is, now there is no point in complaining, because market is a fair game. If you have money, if you have capital, you can also do something similar, but unfortunately we don't, right? So that's the reason, since it is a fair playing field, so if I have the same amount of resources the other person have, then we can compete on an equal level. But if we don't have it, there is no equal level in market, right? So what you can do is mostly try to participate or change your trading style to a way where it doesn't get affected by such kind of moves. So if you ask me from 2017, right, every year I would have maybe told you a different approach to trading. So 1 year a particular approach might have worked, second year some other approach might have worked. So once the leverage went, straddle started working. So after that, say time-based straddle started working. So once time-based straddle stopped working, so easy positional money was there. So now there is a big gap up, gap down. When VIX was high, even simple positional trades were working. So as and when the time changes, you should also start adapting to it. So don't think that whatever you are going to do now is going to be the same case throughout maybe let's say next 3 or 4 years, right? Every year you have to adapt with the market and see what changes you can make to your trading style to better approach the market. So now let me just quickly explain in the next few minutes what I am trying to do mostly, and how I am trying to achieve my same 1.5-2% per month without taking the kind of exposure which I was taking, without taking the kind of risk I was taking. So broader sense, I have actually stopped doing 0 DTE. So I am having very low exposure to 0 DTE. Whenever I get an opportunity, I tend to pounce on it. Otherwise, I simply tend to stay away. So I am now doing more of positional trading, and I will also be giving you a glimpse of what kind of positional trading I am doing, how I am sizing my positions, am I putting a hedge or not, in the next section of the video. So right over here, I have opened my trading account QA0000, which is Quick Alpha's company trading account, where we are trading with a capital of 2 CR. So you can see these quantities. So I'm going to break this down further and simplify it so it becomes easier for you to understand. So what I have done is I am now mostly avoiding trading 0 DTE, and I am either doing 1 DTE or positional trading. So let me just show you the positions what I have. So how I am sizing it is I am going to mostly trade in two index. It can be either Nifty, Bank Nifty, Nifty, Fin Nifty, Bank Nifty and Fin Nifty. So the reason is all of them will be having expiries on different days. Today Fin Nifty and Bank Nifty fell on the same day, but generally they will be having expiries on different day. So what I am mostly doing is I am going to enter one lot for every 10 lakh of capital. So the very first thing is my exposure is diversified across different symbols, and the second important thing is all of these are fully hedged. So let me show you my Nifty trade, for example. So let me just open my Nifty trade. So here you can see that I have 2600 short, 2750 short. Along with that, I also have 2850 long and 2500 long. So this is the trade I have. So today this will constitute to around 88 lots because Nifty lot size has been reduced. So previously it was 50, currently it is 25. So you can see that my best case gain is around 0.5%. My worst case loss is around 0.5 to 0.6%, right? So Nifty position is something which I took today, but I was carrying a Fin Nifty position and which I came out of profit. So now if you take a look at my Bank Nifty, so I would also size it in a way where, because we still have 1 week of time, so there is no hurry to adjust the trade if the market moves, because you can see we have quite far OTM options in Bank Nifty. So that is 48,200 hedged with 500 points away. So let me just show you that. So one we have 48,200 hedged with 500 points away. So you can see this is our Bank Nifty trade. So where we have a max exposure of 6.68 lakh. So now if you put both together, we have a total 4% risk in the worst case. So what do I mean by worst case? Let's say we are tomorrow opening with a 5%, 8% gap down. So our worst case loss is going to be around 5%. But you can see that if there is a simple 1% cap up or 1% cap down, right? So we are not even going to lose around 50k, which is 0.2% of our capital. So hardly with 1% we are losing 30k, which is somewhere close to around 0.15% of our capital. So one thing is what you can see is, so this type of trading is really stress free. So I won't be touching my position maybe till we come below 48,900 or go above 50,000, because I am quite far off, and post that I will even think of adjusting the trade. And second one, the worst case, doesn't matter where the market goes, so my loss is going to be restricted to not more than 5% of the entire capital, 5 to 6%. So even if we are opening with something like 3-4%, so we are going to lose 1.5% of our capital. So this way what I'm trying to do is every week, because there is continuous expiry, so now Nifty will get over. So once Nifty expiry gets over on Thursday, I will again take positions in Fin Nifty, right? So once Fin Nifty gets over, I will take position in Nifty, and I will continue to carry Bank Nifty positions. So this way what is happening is, almost let's say during Tuesday, Wednesday and Thursday, so we'll have continuous expiries coming in, and most of these options will start realizing profits by then, and there is continuous churning of position where I am doing positional. So I am only going to do any kind of intraday 0 DTE if I find an opportunity. Today you can see that if I open the Bank Nifty chart, so after one point Bank Nifty started to come down. So let me just show you that. So you can see that after one point, Bank Nifty started to come down, and when Bank Nifty was around 49,600, so the 50,000 call option was trading around 7 rupees. So I thought, okay, it is a pretty good chance for me to, because it was already 250, the time was 250, there was only 30 minutes left. I thought it was a pretty good chance. So I ended up shorting this at 7.5, very small quantity, and I ended up making 5k. So whenever we get chance like this, we can just try to make 5-10k and build up the position and maybe make 0.5% a month. And with the entire positional trade put together, if we can make 1 to 1.5% a month, we would be ending the whole month with almost around 2%. So this is one way which I am approaching. I'm still not used to trading positional completely, so maybe over the next month I will just make another video of 1 month trading positional options, right? So with this, we are also coming to the end of this video. So as and when in this journey, I want to take you through the journey. As and when I start learning in this journey, I will also tell the same thing to you. So after 1 month, I will tell what are the changes I am making, what I have learned trading 1 month positional option, and how I am going to improve it. I hope this video was useful. And if you have liked this video, don't forget to hit the like button, share this video, and subscribe to my channel. Thank you.